Hi ladies and gentlemen, today I'm going to do a short video to give you a little bit more information about the most popular tax efficient products available for Brits living in Spain who are looking to grow their savings and investments. Now, the most common products are called Spanish compliant investment bonds, and many tens of thousands of you have them already. To quickly introduce who I am, for those who don't know, my name is Sam Kelly. I'm the managing partner of Chorus Financial, and I'm one of the very few fully qualified financial advisors working here in Spain. Chorus Financial are a multi-award winning, fully regulated financial advisory working mainly with Brits living overseas, and unlike many firms here, we promise 100% transparent, client-focused advice, including full disclosure of all fees and commissions. So, moving back to these Spanish compliant bonds, we have a number of providers in the market. Many of you may have heard of the Prudential, SEB, Quilter PLC, Lombard International, for example. Now, the first thing to say is that despite what your IFA, financial advisor, may try to encourage you into a particular bond, they are all treated exactly the same way in terms of taxation for those of us living in Spain. The most important choice for you as a potential investor is getting the best priced option with the highest quality underlying investments. The underlying investments are the portfolio of funds that your financial advisor recommends for you. Unfortunately, all too often in Spain, due to looser regulation we have here, we see people being pushed into expensive, poor quality portfolios that allow your financial advisor to make themselves a few extra quid on the side. Now, I do have to point out on all these videos that Chorus Financial are totally independent to any product provider that we discuss. These videos are purely for educational purposes and they are not intended as a recommendation for you to invest in any particular product. Lastly, before we move ahead with the video, I would say that if you are signing up to any product here in Spain, especially those with a tie-in, for example, 5, 8 or 10 years, it is essential to speak with a Chorus advisor first. These products are often overpriced, and they facilitate eye-watering undisclosed payments to financial advisors, and this can leave clients trapped in unsuitable investments for many, many years. So, let's move back to these Spanish compliant bonds. Firstly, they should not be confused with bonds like corporate bonds, government bonds, even premium bonds, etc. Those are products that generally you hold them for a certain period of time, they'll pay you a fixed return. Investment bonds are different. They do not actually pay generally a fixed return. Rather, they have underlying investment portfolios. These should be specifically tailored for your investment goals. We're not going to cover that today, but for more information about how these portfolios should be designed, you can always visit the Chorus website or contact one of the Chorus team after watching this video. So, here in Spain, the taxation on growth from your income, savings, investments, etc. is as follows. So, on the first €6,000 or any currency equivalent, you would pay 19% tax. From €6,000 to €50,000, you would pay 21%. And above €50,000, you would pay 23%. Don't forget, these rates also apply to your UK investment plans if you live here in Spain. So if you have ISAs, etc., you should also look out. Also, we see a lot of people with UK investment bonds. These are often the same product providers of Aviva, Prudential, etc. And we see people who have been overpaying tax of 20%. Now, I'm not going to go into details about this, but these products are uniquely designed for UK tax residents only, and if you hold them as a Spanish resident, you can be inadvertently paying too much tax. Again, any concerns or questions about this, please contact us after you've watched this video. So, Spanish compliant investment bonds. They can help you invest in a tax efficient way as a resident here in Spain. Let's look at some examples. So, here you invest €90,000 over a given period of time and you make a €10,000 gain. Now, if you didn't make any withdrawals, the plan is fully wrapped against ongoing taxation in Spain, so you would have nothing to pay in tax at this time. But if you wanted to withdraw that €10,000, the growth that you made, you need to picture this coming from a side slice, rather than simply taking all that growth out of the plan at once. So in this case, only €1,000 of your withdrawal is actually seen as profit. and that would be taxable at 19%, so €190. The remaining €9,000 of your withdrawal is simply seen as your original investment coming back to you, so that is completely tax-free to you. This means the total tax payable on that €10,000 withdrawal would be just €190. Even better, in this scenario, your bond provider does all the work for you, they calculate the tax, and they actually pay the tax on your behalf direct to the Spanish tax authorities, leaving you with nothing further to do. Right, let's look at this in a little bit more detail so we can understand it better. As you'll see, despite the profits actually being €10,000, which would normally be above that €6,000 19% threshold, because this plan is efficient, it has only allowed you to realise €1,000 of your growth, leaving the rest inside the bond. And your profits then fall comfortably into that lower 19% tax rate, rather than tipping into the 21% tax rate. The result of this is not only is there far less of your growth exposed to tax, but when the growth that is exposed is actually taxed at a lower rate. So let's have a look and see what would happen if we were dealing with a larger investment. This time a €900,000 investment that grew by €100,000 over a given period of time. Well, as before, if no withdrawals are made, no tax is due. If you decided to withdraw that €100,000, again, we have to apply that beneficial side slice. This immediately means that the vast majority of your income, so €90,000, is seen as the return of your original investment capital, and that is tax-free for you. But this time, €10,000 would be taxable, with €6,000 falling into that 19% tax band, and the remaining €4,000 falling into the 21% tax band. This makes the total tax payable on that €100,000 income €1,980. Again, the product provider makes these calculations and they will pay all the taxes due at the rate of 19% direct on your behalf. But in this case, as €4,000 fell into the slightly higher 21% tax band, you do need to see your accountant or HESTOR at the end of the tax year and make that additional 2% or €80 in this scenario payment yourselves. So, just to summarise, under normal circumstances we have those three levels of taxation on savings and investments here in Spain, which are 19, 21 and 23%. To look at the tax efficiencies of the Spanish compliant bond, we gave two examples. The first, where no income is taken, 100% of your tax is deferred. Nothing is due at any time, meaning that your full investment can continue to grow. With the first investment, we invested €90,000, and you made €10,000 of gains, and when you took the €10,000, just €190 of tax was taken. On the larger investment of €900,000, you made €100,000 in gains, and when you took €100,000 as income, just €1,980 of tax was due, with the rest of your gains safely wrapped up in the bond, or as we say, tax deferred. Now, it's really important that I point out these are just illustrations for those two specific scenarios. The levels of growth are not guaranteed, and if you do want a personalised tax illustration for your own investment amount and income needs, please do get in touch with Chorus Financial. Finally, just a couple of warnings if you are considering this type of product. Firstly, as I said before, if you're being offered any kind of tie-in, for example 5, 8 or 10 years, please do contact Chorus for a second opinion before you sign any paperwork and before you agree to paying any fees. Another really important factor is not only is it crucial to ensure you're not overpaying for the products themselves, but you also need to fully understand how your financial advisor intends to invest the underlying funds after you have signed the paperwork. Now, I have personally reviewed hundreds of these plans from different firms over the years, and sadly I've been unimpressed by the underlying portfolios. These are often just a handful of overpriced funds that will be paying potentially undisclosed commissions to your advisor, and they often create a lot of expense and risk and puts you on the back foot for the lifetime of your investment. Now, in most cases, a good quality portfolio should be highly diversified. We should see a mix of really good quality household name funds like the Royal London, Prudential, Rathbones, Investec, Vanguard and many others. The quality of the underlying portfolio is one of the most important elements to consider when it comes to your long-term financial goals. As you have seen, these products should offer a great solution for Brits living in Spain if you're looking for that tax-efficient investment growth or income, but it is critical that you have received honest, ethical, qualified advice to avoid pitfalls. So please always remember also that investment contracts are intended for the medium to long term. All investments have some level of risk. Obviously, the value can go up and down, and today's video should not be taken as a recommendation to invest in any particular product. If you are considering a Spanish compliant investment bond, or you want advice on any kind of investment or pension transfer, etc., please do contact Chorus by phone, email. You can talk to us on our Facebook, WhatsApp, etc. We can provide links in the video description. So many thanks for your time, and please enjoy the rest of your day.